and people flipping real estate like it's nothing. It feels like every single person has figured out the secret to wealth. But then you look around, you look at your own bank account, you talk to your friends, and you realize most people are still struggling. If everyone is investing, why is everyone still broke? It's a paradox that keeps a lot of us up at night. So today, we are going to pull back the curtain and figure out what's really going on. First, let's address the elephant in the room. Social media is a highlight reel. Nobody posts their losses. Nobody brags about their investment account going down 20%. They only show you the wins, the one lucky stock pick that doubled, or the crypto coin that went to the moon. This creates a massive distortion of reality, making it seem like generating wealth is easy and that you're the only one falling behind. The truth is, for every winner you see, there are countless others who lost money or are just barely breaking even. This is called survivorship bias. We only hear the stories of those who survived or succeeded, not the majority who didn't. Now, let's talk about the nature of modern investing. A huge chunk of what people call investing today isn't really investing at all. It's speculating, or straight up gambling. Investing, in its classic sense, is about buying into a business or an asset with a solid foundation, believing in its long-term growth. It's about fundamentals, research, and patience. Speculating, on the other hand, is betting on short-term price movements. It's buying something not because you believe in its intrinsic value, but because you hope someone else will buy it from you for a higher price tomorrow. Think about meme stocks or highly volatile cryptocurrencies. People jump in because of hype and FOMO, the fear of missing out, not because they've analyzed the company's balance sheet. When you're just gambling on hype, you're more likely to lose than win in the long run. The house always wins, and in this case, the house is market volatility and more experienced traders. Another major reason people stay broke is the get-rich-quick mindset. We've been conditioned to want instant gratification. We want six-pack abs in 6 weeks and $1 million in a year. But real, sustainable wealth isn't built that way. It's built slowly, brick by brick, through consistent, boring habits. It's about setting up automatic contributions to a retirement account, even if it's just a small amount. It's about choosing low-cost index funds and letting compound interest work its magic over decades, not days. The problem is, this method isn't sexy. It doesn't make for an exciting TikTok video. Hey guys, I just contributed another $200 to my IRA doesn't go viral. So, people chase the lottery ticket investments, hoping for a shortcut, and more often than not, they end up right back where they started, or worse. Then there's the issue of financial literacy, or the lack thereof. Our school systems do a terrible job of teaching personal finance. We learn about historical dates and complex math, but not how to budget, how taxes work, or the difference between a stock and a bond. So, people enter the world of investing completely unprepared. They get their advice from an anonymous influencer on social media instead of a qualified financial advisor. They don't understand risk management, diversification, or the impact of fees. For example, many don't realize that a seemingly small 2% management fee on a mutual fund can eat up nearly half of their potential returns over a 30-year period. It's like trying to build a house without knowing how to use a hammer. You're bound to make costly mistakes. Let's not forget the role of debt. It's the invisible anchor holding millions of people down. You might make a decent return on your investments, say 8% in a good year. But if you're carrying credit card debt with a 22% interest rate, you're not getting richer, you're getting poorer. You're effectively losing 14% every year. It's like trying to fill a bucket with a giant hole in the bottom. Before you can effectively build wealth through investing, you have to plug the leaks. High interest debt is a financial emergency, and paying it off is often the best and most guaranteed return on your money you can possibly get. Many people jump into investing while ignoring their debt, thinking they can out-earn the interest, which is an incredibly risky and often losing strategy. Furthermore, we need to talk about the sheer cost of living. It's not just about what you make, it's about what you keep. Wages for many people have stagnated for decades while the costs of housing, healthcare, and education have skyrocketed. Let's be real, it's hard to invest for the future when you're struggling to pay rent this month. If your entire paycheck is consumed by necessities, there's simply nothing left to invest. This isn't a personal failure, it's a systemic issue. So, when someone says just invest 10% of your income, they might be ignoring the reality that for many, that 10% is the difference between having food on the table or not. The pressure to invest can feel tone deaf when you're just trying to survive. So, what's the solution? How do we break this cycle? First, we need to redefine what success looks like. It's not about overnight riches. It's about financial stability and peace of mind. It's about making slow, steady progress. Stop comparing your financial journey to the curated highlights of others. Your path is your own. Second, prioritize financial education. Read books, listen to reputable podcasts, maybe even take a course at a community college. Learn the boring stuff: budgeting, debt management, the power of compound interest. A great starting point is learning about low-cost index funds and ETFs. These are simple, diversified ways to invest in the whole market without trying to pick individual winners. Third, make a plan. A real plan. Start by tracking your income and expenses to see where your money is actually going. Create a budget that works for you. Then, tackle high-interest debt with a vengeance. Once that's under control, you can start investing, even if it's just a small amount to begin with. The key is consistency. Automate your investments so the money is taken out of your account before you even have a chance to spend it. This builds the habit and takes emotion out of the equation. Finally, understand that true wealth isn't just about the number in your bank account. It's about having options. It's the freedom to leave a job you hate, to handle an unexpected medical bill without going into debt, or to retire with dignity. That's the real prize, and it's not won through a single lucky bet. It's earned through discipline, patience, and a little bit of knowledge, day after day, year after year. The journey might not be glamorous, but the destination is absolutely worth it. So let's ignore the noise, focus on our own path, and start building real, lasting wealth.
Let's lay out the numbers. 61% of Americans own stocks. Over 100 million people have 401ks. The market has returned roughly 10% annually over the past decade. Total U.S. household investment accounts exceed $35 trillion on paper. This should mean widespread wealth. But now the other side. Minus 78% live paycheck to paycheck, 64% can cover a $1,000 emergency, $1.13 trillion in credit card debt, $1.77 trillion in student loans.
Let me introduce you to Sarah. She's 35 years old and makes a decent salary, around $65,000 a year. On paper, she's doing everything right. She's diligent, contributing 6% of her income to her 401k. And her employer even kicks in a 3% match. That's almost $4,000 a year going straight into her retirement. Her 401k balance is sitting at a respectable $47,000. Sounds like she's on the right track, right? But here's the reality of her financial life. She's carrying $32,000 in student loan debt with a 6% interest rate. On top of that, she has $8,000 in credit card debt, and the interest on that is a staggering 22%. And let's not forget the $18,000 car loan at 7%. What's missing from this picture? An emergency fund, a down payment for a house. She's diligently investing, yet she feels completely broke. Sadly, Sarah's situation isn't unique. For so many people, this is the everyday struggle. They're told to invest, 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 but they're getting buried under a mountain of high-interest debt. It's a frustrating cycle, and it leaves you wondering if you're ever going to get ahead. So, let's break down why this happens and what you can do about it. We're going to dive into the financial advice that often misses the mark and explore a smarter way to build real wealth, not just a retirement account that feels a million miles away. Stick around, because this is a conversation we all need to have. Thanks for watching.
Reason number 1. People invest too little and start too late. Advisors say you need $1 million to retire comfortably. Some say $1.5 million. Let's be generous and say $1 million.
Reason number 2. Debt eats your returns. Sarah invests $3,900 per year. At 8% returns, that's $312 in growth. Reason number 3. Lifestyle inflation kills progress. You get a raise. Income goes up $10,000. Then, better apartment, better car, more subscriptions, better vacations. Your spending rises $9,800. Your investing capacity rises $200. This is the hedonic treadmill. You earn more, but you don't get ahead. You just upgrade the cage. The wealthy don't do this. They let income rise faster than lifestyle. That gap is where wealth builds. Most Americans close the gap immediately and wonder why investing doesn't change their lives. Reason number 4, most investing isn't wealth building. Buying index funds through a 401k is passive investing. You're betting on other people's businesses. You have no control. Returns are capped. Wealthy people do active wealth creation, businesses, real estate, skills, cash flow assets. They don't just wait for markets. They create value. Most Americans are passengers. The wealthy are drivers. Reason number 5, the system isn't designed to free you. The 401k system locks money away until age 59 and a half. Penalties if you touch it early. Contribution limits. Fees. Dependence on employers. It's better than nothing, but it's a golden cage. Over 40 years, fees alone can consume 20 to 30% of your returns. The system isn't broken. It's working exactly as designed. It keeps people productive, compliant, and dependent, investing just enough to feel hope, but not enough to escape. So what actually works? 1. Eliminate high-interest debt first. 2. Build multiple income streams. 3. Invest in cash flow assets. 4. Invest in yourself. 5. Don't rely only on retirement account. 6. Live below your means permanently. This isn't flashy, but it works.